Hello and a warm welcome to the Open Treasury podcast, your go-to source for the latest news and analysis in corporate cash and treasury management. This show is brought to you by CTMfile.com and the Treasury News Network, where treasury professionals learn and share the information that matters most. My name is Pushpendra Mehta, and my guests for today are Bob Stark, Global Head of Market Strategy at Kyriba. Bob is also known as Treasury Bob, and Craig Jeffery, Managing Partner at Strategic Treasurer. This week, we are covering 8 stories touching on 4 themes. We'll discuss inflation and interest rate hikes in Australia and the Eurozone, including corporate bond deals being called off, the US government exempting food and fertilizers from sanctions against Russia. In payments, Zelle's use at Bank of America surpasses checks. In the world of cryptocurrency, crypto custody activity and regulations generate stories. You can look up these news articles on CTMfile or by the links in our show notes. Let's get started and begin our discussion with the first section that revolves around inflation in Australia and the Eurozone. Australia's central bank, the Reserve Bank of Australia, has signaled the need for further increase in interest rates to combat the country's rising inflation, despite recent rate hikes. The European Central Bank, or the ECB, increased interest rates for the first time since 2011 in order to rein in Eurozone inflation, which reached 8.6% in June 22. The ECB has joined the US Fed and the Bank of England in their fight against inflation, stated that the increase was necessary to limit price pressures over the next 2 years. The European Union and Australia are facing a cavalcade of challenges that include inflation, interest rate hikes, and the possibility of the Australian dollar declining even further in 2022 after touching a 2-year low this month, amid concerns over Australia's slowing economic growth, not to forget worries around recession risks that are enveloping European Union that has reportedly assisted in driving the euro to a 20-year low versus the US dollar. Bob, if I may start with you, from a global treasury perspective or an Australian, Canadian or European treasury perspective, what would you be most concerned about? Rising inflation, interest rate hikes, weakening currency, higher borrowing costs, energy crisis, reduced economic demand, the Russian-Ukraine conflict, or some other factor?
I like that you make me choose between one of those things. The biggest thing is that everything works together. And I mean, we know this obviously from past challenges in the economy. And we're seeing, even though some different storylines play out in different ways, like certainly inflation is higher than it's been in a long time. That's a significant driver towards interest rates being used as a means to try and curtail some of that rapid growth and obviously too rapid growth. The part that's, I don't want to say it's concerning, but I think for CFOs and treasurers, what they really are cognizant of right now is the volatility. That volatility is largely driven because, as you mentioned in that lead up, there's rates that are happening at different times and to different amounts in different parts of the world. That's what creates volatility in the currency side. So if you look at what the US has been doing, the Fed has obviously done some drastic things around increasing rates in the States. If you look at the ECB, they finally reacted. And I don't mean that in any negative way. It's just the fact that they look to their own challenges in terms of fragmentism within the EU. But as they raise rates at a slightly different pace and a slightly different frequency, what you get is a challenge on the dollar and euro and that relationship that you mentioned a moment ago. And that creates that choppiness, which is inevitable. There's really, unless every government entity is going to work exactly in tandem at the exact same time with the exact same raises, which is inconceivable based on all the multitude of economies we're talking about, you're going to get some choppiness. Like if Australia is signaling further hikes, that's going to create some sort of we'll say effect in the markets in Australia, but it's also going to look at the Aussie dollar or Aussie euro or any of these cross rates. They're going to be impacted in slightly different ways. there's no way to avoid that. So if a treasurer is looking at a couple of different things, they're looking at inflation as an indicator of, let's say, future challenges, and especially with the, I don't want to say hyperinflation because that would be a misused term. We'll just say high inflation. What we know is that interest rates are going to change to curtail that. And what does that mean? It means that we have to look at our vulnerability to future rises. We'll look at our balance sheet, look at our income statement. What does that mean in terms of our ability to withstand those interest rate increases or benefit from them, depending on where our liquidity situation is. But it also presents these challenges on the currency side. And those challenges on the currency side obviously depend very much on what your makeup of revenues and expenses is. If you're an American organization, you're generally likely to have more revenues outside the US than you do expenses. Not every case, but generally speaking, that's what most of the clients that we deal with are in that situation. The vast majority of our clients, 15% or have 15% or more of their revenues outside the United States. So what does that mean? It means that the strength of the US dollar has some headwinds for them. Conversely, if you look at European organizations, whether they're domiciled in London, whether they're based out of Paris, whether they're based in Switzerland, whether they're based in Australia, they're going to see some slightly different effects based on the reaction compared to the US dollar. And so it's that choppiness, it's that volatility, and it's that challenge in terms of having the right protections in place to be able to manage that exposure to this currency volatility, which is the result of interest rates, which is the result of inflation, which is a result of a whole host of other things that you mentioned. That would be where CFOs and treasurers really need to pay a little bit more attention.
This idea of volatility, people seeing more volatility, not only with interest rates, which is the locus of what you were talking about, but certainly there's impacts on commodity prices and across the board. So this uncertainty comes about from a number of factors. As Bob was mentioning, the impact can cause uncertainty in our balance sheet or the income statement. He was mentioning some good points about the balance of your flows may be different. And so the impact may be positive or negative from a financial standpoint, but uncertainty is not necessarily treasurers and CFOs' best friend. And so we're in an era of more volatility and increased uncertainty because, as we're talking about, as these articles say, the action of central banks differs in timing and magnitude. Some are farther behind and some are moving more readily. You look at the Fed, they've been moving more dramatically, trying to get caught up. I wouldn't say get ahead of, but trying to get caught up to what they're seeing as inflation. Australia's been moving incrementally, but very consistently, pretty much monthly. They have very low unemployment. Their inflation is what it is. And the ECB is finally moving. I think it's been over a decade since they've made any adjustment. I think we could safely say whether it's late or early, they're certainly late compared to their peers. And all of these have an impact. So acts of war, acts of nature, acts of central banks, or inaction of central banks, as well as acts of competitors, is all leading into this, time of volatility in different areas and some uncertainty, which means getting back to the basics. I think that's not the way Bob described it, but that's the general idea is how do we make sure we bring this volatility down in line with what we're comfortable operating in, given these different variations and acts of different countries or central banks.
Interesting perspective from both of you. You mentioned volatility, choppiness, challenges, uncertainty, and my next story may be connected with this, which is about planned corporate bond deals increasingly being called off as the end of central bank stimulus leaves companies starved of cheap funds, as has been reported in the Financial Times. Bloomberg data for June 22 reveals that pulled or postponed deals in the Europe, Middle East, and Africa region more than tripled compared to May. Analysts at rating agency Moody's warned that companies with low cash flow and high amounts of floating rate debt, where interest payments rise in line with benchmark rates, risk not having enough cash to surface or refinance their debt. Bob, do you think corporate bond deals are being called off to avoid making mistakes in a volatile and uncertain market? What is your opinion on this development?
The best answer is that it's going to be different. We've had a nice run in terms of having interest rates very low. In fact, it's been difficult to use from a monetary policy and fiscal policy standpoint. It's been difficult to pull the same levers as we've historically seen over the past 30, 40 years. And what we all learned in school is traditional tools to be able to manage interest rates as a way to keep the economy in check. We're sort of seeing that emerge now. And that does, I would say, at least for now, signal the end of what we would call the cheap money, to your point. What does that mean for corporates? What does that mean for the prospects? What does that mean for growth? I think are all very reasonable questions. What we look at with our customers and sort of what they're telling us and what we're seeing in aggregate across corporates in all geographies is that they are very focused on their balance sheet. They're very focused on cash, and they're very focused on more effectively managing liquidity. Liquidity ends up taking on almost a different meaning than it has. Liquidity is what can I turn into cash very quickly, but liquidity tends to be that vehicle that investors or potentially future investors or banks, they're potentially engaging in bond deals and other sorts of, we'll say, financial activities to shore up or strengthen or change the composition of balance sheets. Liquidity tends to be that tool where you're looking at what is this organization's ability to generate cash in this environment. And we talked, several moments ago about what this environment is. You have to ensure that you are prevailing and, in fact, thriving against what is exposure to higher interest rates, what is exposure to inflation, what is exposure to currency effects, so that you're showing some resilience to what are otherwise challenging set of financial factors. That ends up being, it never wasn't important. I know it's a double negative, but I'm saying that way intentionally. It's become that much more important if you are going to look for financing, if you're going to renegotiate financing, if you are going to signal that we are actually going to grow in a certain way. So, I think there's a little bit back and forth, Craig and I can have here, but that would be the first start of my answer, is that you have to look at the fundamentals a little bit differently and where the execution is and where the value is.
I would say, Bob, with some uncertainty and certainly some of the volatility here, building on multiple years of very cheap money, not everyone wants to pay a premium. Is this going to, are the rates going to keep going up and we're going to settle on a deal that's not optimal? I think there's some activity that's occurring from that. And to the article that Push you mentioned, there's the quote by Mark Leinoff, co-head of debt for Europe at BNP Paribas. He said there's probably been more transactions withdrawn from the market in the last 3 months than the last 3 years. Now, this is not to say the debt markets are freezing up by any stretch. It's still very scarce, but it still shows a difference of the market flooded with liquidity, very cheap money, and that's changing. And so this changing time means things are looking different. This is not 2008 and 2009. It's not 1987. It's not however far back we need to go, but it's signaling a shift in what's occurring. And this seems reasonable actions due to uncertainty and volatility.
Uncertainty and volatility. Once again, our next section is around some of the important words that you use, which is about the Russia-Ukraine war and agri-commodities exemption from sanctions. The US government has confirmed that sanctions against Russia do not extend to trade in agricultural commodities or fertilizers, amid growing concerns that the war in Ukraine is causing a global crisis of food insecurity. Estimates suggest that up to 40 million more people could be pushed into food insecurity this year as a result of the Russia-Ukraine conflict and its spillover effects. Apart from the humanitarian angle, Bob, do you think from a Treasury perspective that exemption of agri-commodities from sanctions will bring a balance in agricultural commodity prices and any other ramifications?
Yeah, of course. Without getting too political in the answer, I think there's obviously some positives built into this. In terms of the goal was to achieve some level of stability. Some level of stability will be seen. Now, the irony might be is we may not completely realize how much of a positive effect it had compared to if those sanctions were extended and we had further instability, to go back to that word again, around commodity prices, obviously affects not just on inflation, but obviously just the general economy of many of these nations that are in the surrounding area. We can see why the decisions were made that were made. I think it is generally a good thing. Disruption is never a positive thing. From going all the way back to corporate treasurers and CFOs, in America and Europe, there is a trickle-down effect that would have been much more significant if some of these decisions weren't made. Stability is a good thing, and lack of stability is a bad thing, which is a very obvious statement, but I think that's probably the easiest answer to that question.
I'm probably a little more pessimistic about this. Russia's war in Ukraine, there was a lot of sanctions. Passing, exempting fertilizer and food and grain certainly seems to make sense to open it up. But part of that's what is Russia doing? I mean, right after this was inked, they go bomb near the ports to make it harder to get items out. So you get credit for saying, hey, we're going to let food flow, but you do actions that make it harder for that to occur to exacerbate the situation. So, I mean, I think it makes sense, but it's also, you have to look at what people do with that. If that's really freeing up the food issue, it's an issue now, and it's a looming major issue. Just like energy in Europe is a significant issue as well. These are some items that Russia's doing what they can to exacerbate the situation. Not being political, but just looking at what's occurring. I have a lot of ongoing concerns about the actual actions that are taking place and how that will impact both on a humanitarian basis, but also on the global economy. That can create significant global issues.
I agree with your point, Craig, completely. One thing I'm always fascinated by is what are the actual signals that the markets react to? They hear we'll call it the political level decision, and they react off that as an indicator of, oh, this likely means that we're stabilizing or we're going in the right direction. Then the markets tend to tune out some of those, I don't want to say finer details, because that certainly that understates the situation. But whether they react to those signals in the same way, I find that often they don't. And that's unfortunate, because I think the whole picture is really what's important. Going back to your point around the humanitarian side, that's really what matters here. But the markets may pick and choose the information that they react to.
Moving forward to the third section, which is about payments, digital growth, and security. The story that is up for discussion revolves around payments in terms of Bank of America's Zelle transactions have surpassed checks. Bank of America's customers wrote 133 million checks and sent 125 million Zelle payments in the second quarter of 2021 compared to 156 million Zelle transactions, but only 123 million checks in this fiscal year ending June 30th, 2022. My question to you, Bob, is, does this news that Zelle payments have surpassed checks written at Bank of America augur well for real-time payments and digital payments? What are your thoughts?
Yeah, well, Craig's going to laugh a little bit when I say this, but I very appreciated seeing that headline, or actually seeing the detail behind the headline, because my first reaction when I saw that was, oh, we hadn't done that already. We actually hadn't had digital payments surpass checks. And it's because we've seen, and Craig and I, we've spent a lot of time over the years talking about digitization and looking at emerging payments. Obviously, there's different types of payments, B2B versus more consumer-based payments. And this is more the broader number that we're talking about. But I think it is an important step that we've seen digitization take over. I'll let Craig speak for himself, but I would be surprised if either of us thought that this is going to reverse itself, that checks are going to make a comeback, so to speak. Check use decreased, but what the interesting number about that is that Zelle in this case, but there's obviously other types of payment channels that are like this, they increased significantly. So it's not a complete seesaw where one just offsets the other. There are more payments being made, which I thought was a very interesting piece of data out of that report. So what do I think? I think that the sooner checks go away, the better it is for everyone. And I don't mind saying that kind of thing, because there's a lot of things about checks. The cost of issuing and processing and then receiving checks is very high. The challenges it creates for front office and back office systems, back office, particularly on the accounts receivable side, are significant. The more you can go to digitized payments, the more that you can go to real-time payments, the better off that we ultimately are. It makes things go faster from a working capital standpoint, from a cash standpoint, and obviously changes the dynamic of trade finance. In fact, almost invalidating some of the elements of trade finance we've traditionally seen. Now, again, I'm kind of extrapolating, I should say, some of those numbers from what we're seeing in the almost like the P2B space, like the consumer space, and extrapolating those as an indicator of what we expect to happen in B2B. What we're seeing here will happen in B2B, in my opinion, without a doubt. It's just a matter of whether it's months or years and what sort of acceleration that we're seeing. But anyway, I'll stop there. I'm interested in Craig's thoughts, because we've talked about this many times over the years.
I'm thinking about all of our European listeners, and I don't want them to just fast forward to the next section, because they're like, these silly Americans, and to a lesser extent Canadians, still handle paper checks. And it's like, I don't think that's what the story is here so much. It's declining. I have children that are entering the workforce, and they're like, the new employer wants to do direct deposit, and they're asking for a voided check. How do I do that? Because I don't have checks. And it's like every new person coming up is not using checks on an individual side, and it's changing. I'm like, no, you can go to your online portal, click it, send them a PDF of a printed direct deposit form. You don't have to go get checks. You can stop that. I had to write a check today for someone who did work on the house. That's the only way they took it. And that person is north of 60. And most of the people that do work around the house, you don't have to use checks anymore. You can use, like you said, Zelle or some other method of payment. So I guess what we're saying here is the acceleration of something like Zelle, one payment method, has surpassed checks at one of the largest retail banks in the US. That's pretty exciting to me, because the adoption is growing. And I think the key thing that you're saying, that one of the most interesting things you said, Bob, is that payment volume is going up. People are sending more payments. There's less friction. There's less cost. It's very easy to transfer items. I definitely send more payments than I used to. It's almost all digital. Very rarely is it anything else. And this is a good sign, because we're definitely getting less checks. We're growing on these digital payments very, very rapidly. I think there's far more good than there is harm in things like fraud and other issues that might be headwinds for this. So I don't know if I answered your question well, Bob, but this is a great headline and a great trajectory and trend. Slowing checks, rapidly increasing electronic payments, more payments to simplify the economy. That reduction of friction is good on the consumer side as well as on the corporate side.
It is a very American conversation. I say that as a Canadian, but it's a very American conversation to talk about checks, because you're right. Many parts of the world have accepted that digital payments have long been the standard, not just in consumer and personal lives, but in B2B as well. Certainly there's an interest in holding on to paper, whether it's cash or whether it's checks. It's data like this that signals that acceleration towards digital payments is increasing in all factors. And Craig and I both agree that is a good tailwind, and it is important for a more digital economy. What's interesting from our European friends, and Craig, I'm glad you mentioned that, because I was initially thinking more of the reduced checks side. But I think what the really interesting point for our European friends is going to be that we're then going to see this movement towards real-time cross-border payments, which is a concept that's, and I say cross-border, we'll say outside the EU, because within the EU with SEPA instant payments is not really a challenge at all. But when we look at other geographies around the world, we look at the Americas, we look at APAC, we're starting to see the proliferation of these types of real-time payment or instant payment schemes in networks starting to connect. And that's where the real tailwind is going to be for CFOs and treasurers. It's going to create some very interesting opportunities as we can get into full digital payments and we can get into completely instant payments. And right now, we're at this touching point of this, and that's why I like data points that suggest that the movement is going to be fully digital across the board and across the world.
Yeah, the idea of check growth stopping, that took a long time to stop, and then it started to decline. Every time we see an acceleration down of its growth is good, and we see these inflection points and growth shifts upward, a steeper curve on the digital side.
I couldn't agree more. And despite, you mentioned concerns around fraud, people, small businesses, corporates, and individuals are beginning to use digital payments. Good for enhanced adoption. Continuing further with our payments discussion, according to a report by Juniper Research, a UK-based firm, the total volume of tokenized payment transactions worldwide will exceed 1 trillion by 2026, up from 680 billion this year. The majority of the growth is expected to come from click-to-pay options that will enable buyers to pay with a single click using tokenized credentials. My question to you, Bob, is does tokenization present new opportunities for payment processors, and will it help reduce fraud?
So yes, it does. I'll go back to a point that Craig made just a moment ago around friction. Having tokenized payments, which obviously brings in an element of security that's very important when we're doing online payments, that eliminates a lot of the concerns that many organizations have in a B2B world around having digital payments, both sending and receiving. And it simplifies that process. So if you think of, do I want to go digital? Yes. You mentioned some things around fraud. Do I want to ensure that these are resilient payments, that we're not suddenly, because we went digital away from paper, that we changed our process, we open ourselves up to potential hacking or cyber criminals, or just payments that we typed in too quickly and added an extra zero by accident. We want to make sure that we have resilience to all of those things. Tokenization is one element of that. It's making sure that the numbers effectively are secure in that transaction. And so it provides just another level of assurance on top of securing and streamlining your payment processing, so that corporates feel good about being able to not just pay using these methods, but I think the real story around this particular data point is the receipt of those transactions. Receiving money digitally is kind of what drives innovation in this space. And you think of any CFO, CFOs aren't incredibly concerned. I mean, I'll say they're not concerned, but they're not incredibly concerned about having digital payments to pay. Just like they're not as concerned with DPO as they are with DSO, typically. This is the exact same scenario. Do I want to get paid more quickly? Yes, I do. Do I want to make it easier to get paid? Do I want to be able to ensure that the dollars and the data are aligned so that I can actually have a more efficient back end process, back office process, and reconciliation? The answers to all those things are yes. So as a result, when you see what does this momentum mean, it means that it's another signal towards B2B having a greater opportunity to accept digital payments. So that's why I like that. I'm intrigued because the number was pretty far out by 2026. And the growth rate, if you kind of amortize that on a flat line, which it never would be, it'd be a fairly accelerated curve. But if you look at that growth rate, it's actually not that significant from where we are today to where we would expect to be by Juniper's estimate by 2026. I would say that we revisit this a year from now, we might have a different estimate for that end date, because I think there's a great possibility that acceleration is much faster.
I agree with you. I think the acceleration will be faster. I guess the other numbers I don't know, going from, it's about 50% growth from current. And you're also, the expectation would be that the overall economy that's using card payments would grow as well. So I hope this number is surpassed before 2026. The idea of streamlined payments, protecting payments either by encrypting data or replacing key data points with a token and some other methods this is going to be forced more and more and more types of payments, not just card, but, EFT payments in different spheres. So yeah, I'm going to say it's going to surpass that beforehand. I think you're thinking the same thing too, Bob.
The fourth section that merits discussion is around cryptocurrency custody and regulations. Our fourth story is about the French bank BNP Paribas entering the cryptocurrency custody space with Swiss digital asset safekeeping firm Metaco. While many major banks are edging towards crypto custody, Bob, why do you think is this deal particularly significant?
Yeah, it's a great question. And I think very highly of Medico, Fireworks. There's a variety of different organizations that play in this digital space. I actually think it's less of a crypto story, a cryptocurrency story, than it is a digital asset story. And that makes it even more exciting because I think most of us have a pretty reasonable acceptance of cryptocurrencies, perhaps maybe I'm not sure about that for corporate, for the real world. We can put that aside because this deal is about digital assets. It's really, taking things like NFT and looking from we'll call it a corporate mainstream finance standpoint and looking at ways to store and manage digital assets on behalf of, obviously, we'll just say mainstream finance. BNP, Société Générale, which is another one that's worked with these organizations in France specifically. And there's many others. I mean, there's many American banks and others. This is not unique to one particular bank. They're not the first to do it, but they are executing it well, in my opinion, based on where we expect this digital asset, I guess we'll call it industry, fighting for words in terms of, is it story? Is it sort of a next? But it's actually an industry in itself. And its emergence with banks as large and significant as BNP Paribas, Société Générale, before that, I think that is an intriguing line that we will see more and more of. There's organizations that may not be interested in cryptocurrencies for a lot of different reasons, which I'm sure we'll talk about the next little bit, but they definitely recognize the value of digital assets.
I think you're spot on there. I mean, the protection of digital assets, we get more and more digital assets, whether it's cryptocurrency or not. But think of some of the headlines that have happened. Theft of digital currencies. That's been very, very significant. You also have someone forgot their code and they eventually are on the verge of getting locked out, having many millions of dollars go to waste because they can't access it. You also have an example, recently was in the news just this past week of somebody looking to hire these digital robots to hunt through a dump where someone had thrown out their computer equipment that had, I can't remember the amount, but it might have been 100 and something million US worth of cryptocurrency stored on their hard drive that they threw in a dump. Is it important to have proper custody of digital assets? Certainly when it's in sums that are in the millions of dollars, and seeing SocGen and BNP Paribas look at making this is part of that trend. So
interesting. And perhaps the second story also has some connection to this. It pertains to the US Securities and Exchange Commission's plan to require registration from crypto lending firms. Since May 2022, there has been renewed focus on cryptocurrency markets attributed to recent market volatility, which has concerned regulators. Reports indicate that several crypto lenders have faced problems in recent weeks as cryptocurrency prices have fallen. Bob, do you think the Securities and Exchange Commission's plan to register crypto lending companies is because many of these firms may well be investment companies taking hundreds or thousands or millions of customers' funds, pulling it together and then re-lending it while offering pretty high returns just as an investment company or a bank might do? Or do you think there are other reasons or factors at play?
It's a great set of questions. I think the answer is yes to all of that, but I'll get a bit more precise. Anytime there's bankruptcies involved, anytime people are losing money based on a somewhat worrying trend, and certainly cryptocurrencies, you could swap that in towards junk bonds, you could swap that in towards a variety of other financial assets over the years that have suffered this kind of financial loss for individuals and for corporations. So it was about time that you see some level of regulation for the simple reason that people are losing too much money. Now, you could look at the larger storyline. Is it because cryptocurrencies are bad? I don't think that's incredibly relevant to the conversation. It's relevant for different conversations, but for this one, it's that you need some stability, and the industry wasn't able to govern itself. There's a lot of people that came in, didn't have enough information and needed a level of protection. They didn't have that at first. And there's a lot of people that lost a lot of money. And we can look at that kind of asset, the cryptocurrency. We can look whether it was Bitcoin, whether it was Dogecoin, whether it was Ethereum, whether it was something that wasn't even a name brand cryptocurrency that they lost because the currency value went down. Some people have different opinions around whether that's forgivable, whether that's sympathetic, whether that's, well, I told you so. You never should have got in there, like that sort of conversation. But that's not really what the biggest challenge was. I mean, yes, those things were a catalyst. The drops in value of cryptos were definitely a driver for this, but it's the actual business model of these firms that is what the regulation is aiming at, and making sure that there's sufficient liquidity and assets so that if you have your money, even if it goes down by 50% or 60%, it's not like you lost the rest of it because the firm wasn't run very well on the right principles and didn't have the right security in place. So in my opinion, it's much more of forget the crypto part. It's the fact that there's firms that needed more regulation in order to protect those investors.
Finally, I'd like to wrap up this conversation by seeking your opinion on your choice for the biggest or most important story of the past week and why. Craig, if I may start with you.
I'll tell you which one of the two that I was looking at. So the first rate increase by the European Central Bank in 11 years, that's a top contender in my mind because it signifies one of the last huge central banks finally moving on inflation by raising their rates. That's very notable. The other one was B of A's Zelle volumes increasing rapidly. I'm really split between those, but I'm going to go with the acceleration of digital payments as a bigger story in my mind because the other one is a follower. It's not one of the first banks. It's one of the later ones. I'm going with the rise in digital payments as my top story.
What about you, Bob?
Well, those are my same two short lists in terms of the digitization of payments. The data point was Zelle, as well as the fact that ECB finally was able to join the rate raising party. So I'll choose the other one just for fun. Because it does signal that there's significant challenges in inflation that need to be curtailed globally. It also does raise some challenges and hopefully solves, but unlikely to really solve, the fact that we have a very rising US dollar against the euro. And this is presenting many challenges for global organizations. This vulnerability to interest rates will certainly continue, and the ECB's raising rates doesn't necessarily impact that. There's more to come.
There's more to come. Thank you, gentlemen. This is a very interesting and informative conversation. I'd like to thank both you, Bob and Craig, and to our CTMfile audience for joining us on this edition of Open Treasury. Please subscribe and look in the show notes for the article links. Thank you. This podcast is provided for information purposes only, and statements made by CTMfile or guests on this podcast are not intended as legal, business, or consulting advice. For more information, visit ctmfile.com.